When should you take Social Security? The decision. Most people get wrong. Most financial advisors will tell you to wait until age 70 to claim Social Security. And for a lot of people, they are right. But for a significant number of Americans, people with large individual retirement account balances, people with health conditions, people with a spouse who did not earn much, following that advice could cost them tens of thousands of dollars. The problem is not the advice. It is that most people apply it without understanding the one variable that changes everything: taxes. Here is the decision in plain numbers. Claim at 62 and you receive roughly 30% less than your full retirement age benefit, permanently. Wait until 70 and you receive roughly 24% more. For an average earner, the difference between those two choices is around $1,000 a month. Over a 20-year retirement, that is $240,000. That is the number that gets quoted in every Social Security video. It is real, and for many people it is the right framework. But here is what that calculation ignores entirely: taxes. And in some situations, specifically if you have a large traditional individual retirement account or 401k, waiting until 70 can trigger a tax collision that quietly wipes out a significant portion of that $240,000 advantage. That is what this video is about. There is no universal right answer on Social Security timing. Anyone who tells you otherwise is selling something. What I can give you is a framework, 5 questions that, when you answer them honestly, will tell you which direction makes more sense for your specific situation. Question 1. What is your health and family longevity history? Question 2. Do you have a spouse? And is there an income gap between you? Question 3. Are you also drawing from a traditional individual retirement account or 401k? Question 4. What does your income look like between now and age 73? Question 5. Is the market volatile right now? And are you relying on your portfolio for income? Every one of those answers changes the maths. Let us work through them. The break-even age between filing at 62 versus filing at 70 is somewhere between 78 and 81. If your health history or your family longevity suggests you are unlikely to reach that age, the case for waiting weakens significantly. This is not pessimism, it is arithmetic. The goal of Social Security timing is to maximize lifetime income. If the timeline is shorter than average, an earlier filing may produce more total income. Full stop. Now for married couples. This is where the real money is made, and where most people leave the most on the table. If one spouse earns significantly more than the other, the lower earner filing at 62 while the higher earner delays to 70 creates two things simultaneously. It provides household income during the gap years, cash flow while the higher earner waits, and it maximizes the survivor benefit, because when one spouse dies, the surviving spouse receives the higher of their own benefit or the deceased spouse's benefit. The higher earner delaying to 70 does not just grow their own monthly check. It becomes the surviving spouse's permanent income floor for however many years they continue to live. That is a financial decision with consequences that extend decades past the original filing date. Most couples never model it that way. The Social Security Optimizer Inside Retirement Ready US models spousal coordination for your specific ages and benefit amounts, showing the lifetime value of different filing combinations for both spouses, including the survivor benefit calculation. Link is in the description. Question 3 is the one most people skip entirely, and it is the one that matters most if you have a traditional individual retirement account or 401k. And this is where this video goes somewhere neither the generic advice nor most of the competition ever goes. Here is what happens. Social Security is not tax-free. Depending on your combined income, your adjusted gross income plus half your Social Security benefit, up to 85% of your benefit becomes taxable income. For a married couple filing jointly, the 85% threshold kicks in at $44,000 of combined income. That sounds like a comfortable buffer until you add a 401k withdrawal or a required minimum distribution into the picture. Here's the collision. You are 70. You have just filed for Social Security. Your monthly benefit is $3,800. That is $45,600 per year. At the same time, you have just turned 73, and the IRS now requires you to take money out of your traditional individual retirement account, whether you need it or not. On a $1 million individual retirement account, your first required minimum distribution is approximately $36,000. Add those two income streams together. $45,600 from Social Security plus $36,000 from the required minimum distribution equals $81,600 in taxable income. At that level, 85% of your Social Security benefit is taxable. You are firmly in the 22% bracket. And because you waited until 70, your Social Security benefit is larger, which means more of it is taxable, not less. The larger the delayed benefit, the bigger the tax collision when required minimum distributions begin. Waiting until 70 can amplify a tax problem that was always going to exist, but that many people have never modeled. Now here is the part that almost nobody talks about, and it is the most important thing in this video for anyone with a significant traditional account balance. The years between age 62 and age 73 are your golden window. Your income is lower than it will ever be again in retirement. Your individual retirement account has not started forcing distributions yet. Social Security may not have started. This is the exact period to execute Roth conversions, deliberately moving money from your traditional individual retirement account into a Roth individual retirement account at a low tax rate, so that money grows and withdraws completely tax-free for the rest of your life. Filing for Social Security early can actually work in your favor during this window, because it replaces some of the taxable income you would otherwise have to take from the individual retirement account. If you are drawing $50,000 a year from your individual retirement account to live on, and Social Security provides $22,000 of that, you only need $28,000 from the individual retirement account. Your individual retirement account balance depletes more slowly. But more importantly, you have freed up bracket capacity for Roth conversions. For the right person, someone with a large traditional individual retirement account and a long runway before required minimum distributions begin, a coordinated strategy of filing Social Security at a reasonable age and aggressively converting traditional individual retirement account money to Roth during those years is one of the most tax-efficient retirement strategies available. The $240,000 advantage of waiting until 70 looks very different when you account for the tax collision at 73 on a $1 million account versus a $600,000 account that was partially converted during the golden window. I cover the exact Roth conversion maths in the video linked at the end of this one. It is worth watching alongside this one as a pair. Question 4. What does your income look like between now and age 73? If you retired at 62 and you are drawing entirely from your individual retirement account to fund your lifestyle, every dollar comes out as fully taxable ordinary income. Social Security can replace some of that individual retirement account income in a way that is often more tax efficient, because only up to 85% of Social Security is taxable at most, and in the early years of filing, often significantly less. For some people, filing at 62 or 64 rather than 70 actually reduces their effective tax rate and opens room for Roth conversion simultaneously. Context determines everything. Question 5. Is the market volatile right now, and are you relying on your portfolio? If you are retired and the market drops 30% in your first year, every dollar you pull from a declining portfolio locks in a loss. Filing for Social Security earlier creates a guaranteed income floor, reducing or eliminating forced portfolio sales during a market downturn. For people without other guaranteed income sources, no pension, no annuity, this sequence of returns protection alone can justify earlier filing, even if the lifetime benefit calculation would otherwise favor waiting. Here is how to think about your own decision. 3 questions, honest answers. First, what does your health history tell you? If your family does not typically reach 80, the break-even maths are working against delayed filing. The case for earlier claiming is stronger than the standard advice suggests. Second, do you have a large traditional individual retirement account? If yes, model your required minimum distributions. Understand what your taxable income looks like at 73 when both Social Security and required minimum distributions are running simultaneously. Waiting to file may amplify a tax problem you have not fully seen yet. The golden window for Roth conversions is happening right now, and how you use it matters as much as when you file. Third, are you married with a meaningful income gap between you? If yes, spousal coordination, specifically the lower earner filing earlier while the higher earner delays, almost certainly beats both of you filing at the same age regardless of what that age is. The survivor benefit calculation makes the higher earner's delay far more valuable than most couples realize when they first look at the numbers. Answer those 3 questions honestly, and the decision becomes significantly clearer. There is no single right answer, but there is almost always a right answer for your specific situation. The mistake is treating Social Security timing as a standalone decision rather than as one variable inside a complete tax and income strategy. Do not make this decision in isolation. Log into ssa.gov this week, pull your projected benefit at 62, 67, and 70, and write those 3 numbers down. Then, look at your individual retirement account balance and estimate what your first required minimum distribution will be at 73. The interaction between those 2 numbers is where the real decision lives. Links to the Social Security estimator and a required minimum distribution calculator are in the description. And if you want to understand how your Social Security income fits into your full tax strategy, specifically the Roth conversion window I mentioned, that is the video to watch next. Hit like if this was useful. Subscribe for more U.S. retirement planning content. I will see you in the next one.